This week on Wealth Track, they say the grass is always greener on the other side of the fence. But financial thought leader Richard Bernstein and great investor Bill Wilby say that is not the case for investors right now. Why both say staying at home and buying American are the way to go. Next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. They say the grass is always greener on the other side of the fence. But according to this week's Wealth Track guest, this is one of those times when Americans are better off investing on their home turf. If you look across just about any border or ocean for that matter, except for the one immediately to our north, Canada, the outlook is pretty grim. A series of charts from top-ranked independent research firm ISI Group tells the tale. Unemployment in the Eurozone, for instance, has been soaring and is in double digits. Of course, there are enormous variations between Germany in Northern Europe and Greece in the South, but we are talking about depression-level joblessness in some southern countries. Unemployment rates in Spain are around 25% and as high as 50% for those under 25 years old. Even the mighty BRICS are faltering. The economies of Brazil and India have slowed dramatically. And China, considered by many to be the new engine for world growth, is also seeing its GDP momentum breaking. As ISI points out, policymakers around the world are under enormous pressure to do something. By their count, there have already been more than 160 stimulative monetary and fiscal policy initiatives announced around the world over the past 9 months alone. Now, those actions and the global slowdown they are meant to counteract are being dramatically reflected in the decline in 10-year government bond yields in the developed world, including the US, Canada, Europe, Japan, the UK, and Australia, some hitting record lows. According to this week's guest, the US is ahead of the pack in addressing its economic issues, and its markets represent the best value and prospects of just about any place in the world. One is financial thought leader Richard Bernstein. Bernstein made his name as the chief investment strategist at Merrill Lynch, where institutional investors ranked him among the top investment and quantitative strategists for 18 years, 10 in the top spot. In 2009, Rich launched his own strategy and money management firm, RBA, which stands for Richard Bernstein Advisors, where he now oversees assets of about $800 million, including 2 mutual funds under the Eaton Vance name. All asset strategy and equity strategy, plus several asset allocation and income strategies in ETFs and unit investment trusts. Great investor Bill Wilby is the former head of equities for Oppenheimer funds, where he oversaw more than $120 billion in assets in 70 mutual fund managers. But Bill's great investor status comes from his 12-year run as portfolio manager of the Oppenheimer Global Fund, which was ranked #1 in its category for his entire tenure. Bill retired from professional money management at the top of the market in 2007 and has been running his own retirement portfolio ever since. He and Rich have been Wealth Track regulars since the beginning, and once you hear them, you'll know why. I began the interview by asking them why they favor U.S. stocks above all others.
I think that when people talk critically about the United States, they kind of have blinders on, and they think that the United States is the only place where there's a credit bubble deflating. And they forget that there's one deflating in Europe, and the early warning radar has been blipping all over the emerging markets for the past 6 to 9 months as credit bubbles begin to deflate in the emerging markets. And so the United States is ahead of the game relative to a lot of these other parts of the world. And you know, if you think about what fueled a lot of the markets around the world in the last 10 years, it's been credit. But now a credit bubble's deflating. That wasn't the story in the U.S. market. And so as these credit bubbles deflate around the world, I think we're going to find that U.S. assets become more and more attractive to people, not just in the United States, but around the world overall.
But why is that? Why, if the credit bubble is deflating here first, does that make our stock market more attractive?
Well, I think that's already discounted into stock prices. I mean, I think it's very hard to argue that the U.S. market is outrageously expensive as it might have been 3 or 4 years ago. I think U.S. assets are really, at worst, fairly valued, at best, very undervalued. That's not true around the world. If you look at similar valuations, even in Europe now, but certainly in the emerging markets, you'll find that a lot of this bad news has not yet been fully discounted.
So, Bill, your reason for favoring U.S. stocks over just about every other market?
Well, Consuelo, when I was managing global portfolios, one of the simple rules we used to have was the best time to catch the sweet spot of a market cycle was right when a currency has bottomed and has started to rise, because you get the translation gains of the rising currency, but the competitiveness gains of the weak currency historically, the fact that it's come down a long way. And if you look at the US, that's exactly where we are. The real value of the dollar, that's the inflation adjusted currency, is hitting all-time lows right now, whereas the nominal value of the dollar is starting to appreciate. And it's just a perfect sweet spot situation for the United States. I think other reasons are, if you look at liquidity, we've had banks not lending money for 3 or 4 years right now, and other banks around the world are contracting liquidity. Banks in the United States are starting to grow loans at a double-digit pace. And so that, again, puts us in the sweet spot of the liquidity cycle.
Right now, there's a global withdrawal from equities occurring among institutions and certainly individuals. So, a lot of people are questioning, why stocks at all as an asset class? So why stocks at all? I mean, you two have basically the freedom, you especially, Bill, because you're just running your own retirement portfolio, so you don't have to invest in stocks at all. But
Right.
Rich has an all-asset portfolio.
Sure, absolutely.
And so why stocks as an asset class at all? I mean, what's the attraction? Why should they still be an important part of our portfolios?
Well, 2 things there, Consuelo. Number one is, should you be in stocks versus bonds? But I think the more important question is, should you be in U.S. assets, whether it be stocks or bonds, versus assets outside the United States? And I'll just say we think U.S. assets in general are very attractive, whether they're stocks or bonds. On the question of stocks versus bonds themselves, look, as I said before, valuation of U.S. equities, I think, is at worst fair value right now. And if you want to make an attractive story, you could say it's very, very undervalued. So I think the question is, do you want to buy a cheap asset? Historically, buying cheap assets is not a bad way to grow wealth through time. I think, given that we have all this negative sentiment about the United States and everything else, I think it's a time to be buying cheap assets. Does that mean it works in the next 2 weeks? Maybe not. Does it mean it works in the next several years? I think it does.
But we've had 2 50% declines in the last decade in stocks, in U.S. stocks. As well as in other, like emerging markets and everything else. So Bill, what's the argument for stocks, just in general, as an asset class?
What you have to do is you can't evaluate stocks on what they're going to do next year or this year or in a 2 to 3 year time horizon. You've got to think, what are these businesses going to be worth 10, 15 years from now? And historically, if you've ever bought a market that's down on a rolling 10 to 12 year view, which is exactly where the U.S. market is now. Prices are below where they were in March of 2000. You virtually never lost money over the subsequent 10 to 20 years, and in most cases you achieved abnormally high returns relative to the mean return. So that would argue for double-digit returns on a 10-year view. Now, does that mean that stocks can't go down 10 or 15% in the second half of this year? Absolutely not. It could easily happen. But you have to buy equities with a very long-term view. And long-term, I mean really long-term, not 2 to 3 years. And we had the last one of these sideways trading markets was from 1965 to 1982. We're 12 to 13 years into a similar cycle. If you bought stocks in 1978, which is about the time equivalent of where we are right now, you made massive amounts of money in the S&P. In fact, the bottom that it hit in the recession of 1982 was higher than the low when you bought stocks in 1978. So I think, again, it's a very good time to buy U.S. equities.
To that point, in 1979, I think was the famous Business Week cover, The Death of Equities. We just had a similar headline in the Financial Times recently. So, I mean, could we be at that kind of a turning point, do you think?
I think so. I think if we had been here, we've been doing the show 10 years ago, Consuelo. Right. The number one question on your viewers' minds would have been, when do we get back into technology stocks? And they would have never considered investing in emerging markets or commodities or energy or REITs or gold or any of the things that outperform in the next 8 to 10 years. Now they're watching your show and they want to know, when do we get into emerging markets and gold and commodities and energy
and alternative investments,
alternative investments. Right. And I am never asked, where are the great opportunities to invest in the United States? So think about how bullish everybody was 10 years ago, 12 years ago, as Bill pointed out, on U.S. equities. The dollar was considered to be the currency. I mean, people forget they have very short time horizons here. But 12 years ago, you had to be in the United States. The U.S. was the currency. We're 180 degrees different right now. The sentiment could not be more attractive for U.S. equities.
So let's answer that question. Where is the best place to invest in the United States? Well, right now,
our favorite theme is actually in small cap U.S. banks. In our funds, we have very high weight in U.S. small cap banks, and the reason why is they're very sensitive to the U.S. economy. They're benefiting from the improvement in employment, albeit the employment is not very straightforward and it's a little bit shaky and everything, but it still is improving employment. The improvement in housing, which is beginning to stabilize, and they have no exposure to the deflating credit bubbles outside the United States, which the big multinational banks do. In fact, I would argue the big multinational banks are leading with their chins into these deflating credit cycles abroad.
And let me ask you, Bill, because I know this is one of your favorite themes about the financials in general, and certainly the large multinational banks, that you think that we are in a long-term downtrend among the financials, right? Do you want to explain that?
I think the financial industry as a whole got enormously overcapitalized. And capital is coming out of the industry, and I think we're in the third or fourth inning of that process right now. However, I'm intrigued with his idea about small cap U.S. banks, because I actually think that could be, if there's an exception to what I'm saying, I think that's an area, a pocket of safety that you might find in the financial industry is in small cap commercial banks.
Rich actually wrote a book about the noise in the market several years ago, and to avoid the noise in the markets. So there is a lot of noise in the markets right now, it's the election, it's the Eurozone, it's China imploding, whatever it is. Right. So what noise should we not pay attention to? I want you to take some worries off my list.
The best thing you can do for your portfolio is turn off your TV, except for your show, of course. Turn off the TV for the next 5 months, because this is election information is always bad information. It's horrifically bad in a presidential election. And so the worst thing you can do for your portfolio is listen to Washington in the next 6 months or so.
What noise would you listen to, Bill Wilby?
I think this is.
What are you paying attention to?
The whole idea of these big risks that are out there, whether it be the Eurozone, a China implosion, you could run off Iran, you can run off a whole list of them. And the interesting thing about them is people don't look at them, but they're bidirectional risks. They are not just unidirectional risks to the downside, because they're partially discounted in the market. Anything that you pick up and read about in the newspaper has some degree of probabilistic discounting in the market. So if 10 or 20% probability of an Iranian nuclear problem or Israeli strike on the Iranian nuclear facilities is discounted in the market, it means if it happens, the market can go down, but if it doesn't happen and there's a deal, the market can go up enormously as these risks that are discounted in the market come off.
So what risks, upside or downside, do you think we should pay attention to?
I would point to the emerging markets. I think most investors have very little understanding about what spurred the emerging market growth in the last 8 to 10 years, and that was credit. They were very credit-related investments. And a good example would be China and this great Chinese infrastructure that everybody's heard about. Nobody ever asked, how did they finance all that infrastructure? The answer is through bonds that municipalities took out, they can't pay back. The government has assumed all that, and now the People's Bank of China has a balance sheet that's 50% bigger than the Fed's balance sheet. Why people are worried about the dollar is beyond me when there's bigger issues going on in some of these emerging markets. Those, I think, are the risks that most people have not discounted in their portfolios, because you'll still hear most people say that the future is in the emerging markets.
Right.
And that's what worries me more than anything else.
But just to add something to what Rich was saying about emerging markets, as I mentioned, the sweet spot being for the U.S. being buying a currency that's down and is just starting to go up. The opposite of the sweet spot is buying currencies that have been up and are just starting to go down. And if you look at the last three emerging markets crises, going back to 1979, early 1980s, and then in the 97, 98 timeframe, both of those came in the wake of emerging market currency appreciation, emerging market euphoria, and the currencies which reduced their competitive position. And now you're hearing the anecdotes about it's cheaper to produce in the US right now than it is in China. All of that's very real, and they're losing competitiveness. And you take a place like China, they're artificially keeping their currency up right now, which means they're undergoing a severe monetary contraction as we speak and as they try to hold their currency up. And so I think that China is in a particularly difficult slot, because whereas you can start to see the Brazilian real go down and the Malaysian ringgit go down, China, because of the politics, can't let its currency fall, which means that the monetary squeeze in China is going to be tighter, not easier, than in the rest of the emerging market world.
Wow. So let's talk about some major investment themes, where we can make and protect money. And Rich, it was basically small company U.S. stocks favored over large company U.S. stocks, right? But you Bill, are leaning towards larger cap stocks more?
Well, I've kind of liked large caps. If you look, small caps have been the place to be for the last 13, 8 to 10 years anyway. It's a long downtrend in large cap relative to small cap. And I'm starting to get of the view that we're kind of bottoming out in that small cap versus large cap trend. And for a number of reasons, I think we do have a lot of political exogenous uncertainty in the markets. People like to run for safety and those things. And we've had, in similar circumstances with the dollar going up and things like that, that's when you see the market narrow. You saw it happen in 1998. Again, very similar time to when the emerging markets were rolling over. The market got you had the Nifty 50 again like you did in the early 70s. I could see us moving into a kind of market where you have a new Nifty 50, Apple, Google, a couple of these guys, the only ones who are able to keep an earnings growth rate going in the face of margin pressures and earnings decline in the rest of the market.
Why small cap, though, and which are under-owned by most Americans?
They are. We like small cap simply because of their lack of exposure to what's going on around the world. If you think about most people's argument is, right now, you either want to invest in the emerging markets or indirectly invest in emerging markets, say by buying multinational companies that sell to the emerging markets. Our strategy and what's embedded in all our funds is the exact opposite. We're trying to shield ourselves from the emerging markets. And therefore, I don't think most people appreciate that the U.S. economy was the only major economy in the world last year, in 2011, that actually improved during the year, right? I mean, there's so much negative stuff. It was the only one that improved. Now, that's important because markets don't move on the absolutes of good or bad. Markets move on better or worse. Bill said that, kind of a couple of times indirectly. And so the U.S. economy, although it's not improving at the rate that everybody wants, it is improving. And therefore, we want exposure to that improving economy. How do you get that exposure? Is through more domestically based stocks, which are generally smaller.
Global search for income, very important, especially for our demographic. People are looking for income, and it's a low-income environment. Where do we go for income?
In my own kind of personal portfolio, I've used municipal bonds, which I think are attractive. The default rates are historically very, very low. So even if we do get a wave of municipal defaults, it's probably going to be in a very low percentage amount of the total capitalization of the municipal bond market. I like it. They're also less correlated with other bond instruments in there, and you get some significant tax advantages. So you can get tax equivalent yields of 6 and 7% in long-term munis right now, which I think is very attractive.
So let me ask you about the most vilified security in the world right now, or at least in the U.S. right now, U.S. Treasuries. And each of you, it's so interesting, actually are on the same page. U.S. Treasuries, you own them in your retirement portfolio. You have a rule of thumb.
I think long-term treasuries, for example, are negatively correlated with equities, and
So
they're a
for
wonderful
starters,
hedge
yeah.
if you have a big chunk of equity in your portfolio. It's a great way to reduce the overall volatility of your portfolio. My kind of trading rule of thumb, and I use trade because to me a trade is a 2 to 3 year time horizon. So my trading rule of thumb is buy them when the yields get over 4 and up into the 4.5%
Right, and
area.
again, this is the 30-year Treasury bond.
30-year Treasury
Right.
bond, and then sell them when the yields get down to 2 and get down under 3.
So
and I've done that. I've done that a couple of times over the last 3 or 4 years. But I mistakenly sold when we hit 2.5 in October of last year, and I sold at the end of the year or first part of this year, and I thought I was looking real smart for a while, and now we've come back down into plumbing new lows, so I may not be the best person to talk to on that.
Rich, Treasuries, your view of U.S. Treasuries and the role they have in a portfolio.
Well, Bill mentioned something a second ago about Treasuries having a negative correlation to stocks. And I think what's more important is Treasuries are about the only major asset class that has a negative correlation to stocks.
That's right.
So if you think of diversification in your portfolio like a seesaw, right, you're supposed to have some assets go up, some assets go down. The fulcrum of the seesaw is supposed to be the volatility of your portfolio. Right now the seesaw is very imbalanced. It's all on one side. And the only asset class, the only major asset class sitting on the other side of the seesaw is Treasuries. So unless you're going to short some of these other asset classes over here, there's no way to mute the volatility of a portfolio right now unless one holds Treasuries. You have no choice.
So let's go to the one investment we should all own some of in a long-term diversified portfolio.
It's got to be U.S. small cap stocks. I think I was on your show last time. It could have been 3 years ago or 2.5 years ago, whatever it was. And I said the exact same thing then, and I'm saying the exact same thing now, that I think that this is something that people just can't believe that the long-term growth story would be here in the United States. The projected earnings growth rate for the Russell 2000 right now is a mere 6 times the projected earnings growth rate on Chinese stocks.
Wow.
The best growth story in the world is right here in the United States, and people refuse to believe it. So since I can't recommend my own funds, I would say something like the Russell 2000 ETF or something like that.
Would you go for the growth component? Because they do split them. There's a growth Russell growth index and there's a Russell value index.
I personally don't think you have to get that picky. Okay. I just think you want exposure to the domestic U.S. economy, and I think through the equity market, that's the prime way to do it.
And so your one investment for a long-term diversified portfolio is?
I did a similar thing. I figured whatever my one investment was the last time, I ought to recommend the same thing again. Otherwise, it wasn't a good investment. And so I recommended the Vanguard Dividend Growth Fund. Mm-hmm. It's a pure U.S. exposure. We've got dividends in there. It yields over 2%, which again, in just pure yield terms alone, is equivalent to the rate of inflation, but you've got a growing dividend stream, and historically dividends in there have grown in high single digits, so you're looking at a total return of double digits. The fund's been in the top decile for virtually all time periods. It's well run. It's kind of run with an algorithm, so it's mechanical in the way that they choose their dividend achievers, and so I like all those aspects of that particular fund.
I just have to add one thing for compliance purposes. We have and do own that ETF that I mentioned.
Which ETF is that?
The Russell 2000.
Oh, the Russell 2000 ETF. Okay.
Right.
No, that's a good point. All right. Well, thank you both so much for a spirited discussion and some real surprises here. But, that would never surprise me with each of you. So that's great. That's why you're here. So, Rich Bernstein, so great to have you here. Thank you so much. And Bill Wilby, lovely to see you as well.
Thank you.
At the conclusion of every Wealth Track, we try to leave you with one suggestion to help you build and protect your wealth over the long term. This week's action point is make sure your portfolio is truly diversified. Now, this has become much more difficult to achieve in recent years because the markets have become highly correlated. Richard Bernstein points out that the asset classes that used to behave differently from the stock market, such as real estate, corporate bonds, emerging market government bonds, and emerging market stocks, even commodities and hedge funds, now move to varying degrees in lockstep with stocks. As Bernstein points out, treasuries remain the only asset class with a negative correlation to equities, which is why he and Bill Wilby hold treasuries in their portfolios to offset stock behavior and reduce volatility. Well, next week we're going to have an exclusive television interview with another great investor who describes himself as an authority-resistant troublemaker. The Tocqueville Fund's Robert Kleinschmidt will join us with his single most contrarian investment idea. If you want to see our Wealth Track interviews ahead of the pack, subscribers can do so 48 hours in advance. To sign up, just go to our website, wealthtrack.com. You can also watch previous shows and find past One Investment and Action Point recommendations there. And that concludes this edition of Wealth Track. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Tocqueville Asset Management, contrarian investors combining independent thought with in-depth research.